Okay, let's be honest. When you hear D&O insurance, your eyes probably glaze over a little, right? I mean, it doesn't exactly scream excitement. But hold on. This stuff is way more important than you might think.
Oh, yeah, absolutely. It can be the difference between sleeping soundly and lying awake worrying about losing everything.
Exactly. This isn't just about protecting some faceless corporation. This is about protecting real people.
The people who lead those companies, who make the tough decisions, who take risks, they need protection too.
Yeah, totally. So imagine you're on the board of directors for some hot new tech company. Everything's going great. You're making big moves. Then, boom, a lawsuit hits.
And suddenly it's not just the company's assets on the line, it's your house, your savings, everything you've worked for.
That's where D&O Insurance, Directors and Officers Insurance comes in. It's like a safety net for those leaders, a way to manage the risks that come with making those big calls.
Right, and it's more complex than people realize. It's not just one blanket policy. It's structured in a way that really addresses the different levels of risk involved.
Okay, so today we're diving deep into the world of D&O Insurance. We're going to break down these policies, look at the different parts, and really get a handle on how they work. We're calling this our deep dive into the ABCs of D&O insuring agreements.
Because believe me, there's an alphabet soup of terms and conditions here. But if you can understand the basic structure, you can really understand the value of these policies.
Exactly. So let's start with the basics. What are the key building blocks of a D&O policy? I hear there's something about a side A and a side B.
You got it. Think of it like a three-layered cake, okay?
Mm-hmm.
Each layer provides a different type of protection.
Okay, I like where this is going. Love cake. So give me a slice of that first layer. What is this side A all about?
Side A, that's like your personal bodyguard in the world of corporate lawsuits. It's designed to protect the individual directors and officers of a company. So let's say you're on that board and the company gets sued, right? For whatever reason, maybe they can't or won't pay for your defense.
Uh-oh. Sounds sticky. So what happens? They just throw you to the wolves.
Nope, that's where Side A steps in. It covers your legal costs, any settlements that come up. It basically makes sure your personal assets are protected.
Okay, that's a huge relief. So side A is there for you when the company itself can't or won't help. I bet that makes a big difference when talented people are deciding whether to join a board.
You bet it does. It's all about peace of mind. You know, I'm making these decisions, taking these risks, but at the end of the day, I have this protection in place.
So what kind of situations might trigger side A coverage? When does this personal bodyguard actually spring into action?
Well, the most common scenario is when the company simply can't afford to indemnify you. Maybe they've gone bankrupt, or they're facing financial troubles, or maybe there's a conflict of interest that prevents them from legally backing you up.
Like they're being sued too.
Exactly. They might be named in the same lawsuit, so they can't exactly be on your side financially and legally.
Makes sense. Okay, so side A, that's the individual protection layer. What about side B? What flavor is that?
Okay, so side B is like the company's reimbursement plan. It kicks in when the company does indemnify its leaders, so they cover the costs up front, and then side B reimburses them for those expenses.
So let's say the company spends a boatload of cash defending their CEO in a lawsuit. Side B helps them refill the coffers a bit.
You got it. And this is crucial, especially when you think about the costs involved in these legal battles. We're talking lawyer fees, expert witness fees, settlement payouts. It can add up really fast.
Especially for public companies, right? I feel like I've heard about those huge class action lawsuits from shareholders.
Exactly. Those can be financially devastating. Side B helps the company weather the storm, prevents one big lawsuit from sinking the whole ship.
Okay, so we've got side A, the personal protection, and side B, the company's backup. But wait, there's one more layer to this D&O cake, right?
Right, and this one's a little different. We call this side C entity coverage. This one's all about protecting the company itself.
So if the company gets sued directly, side C steps up to bat.
You got it. Think of it as the shield for the organization itself. Now, this is where it gets a little tricky, because side C coverage can differ depending on whether the company is public or private.
Oh, that's right. I remember hearing something about that. What's the difference?
Well, for public companies, side C is often limited to what we call securities claims, meaning lawsuits from shareholders who allege that the company, misled them about their financial performance or violated securities laws, that sort of thing.
Got it. But private companies have broader coverage.
Exactly. Their side C coverage is more comprehensive, extending to a wider range of legal challenges.
So why is there that difference?
Well, it really boils down to the types of risks each company faces. Public companies, with their stock traded on the open market, are much more vulnerable to those shareholder lawsuits. It's just part of the territory.
That makes sense. So private companies have different vulnerabilities because they operate in a different environment.
Exactly. It's a different legal landscape, and that's reflected in their D&O coverage.
Okay, so the next time someone starts talking about D&O insurance, I'm not going to tune out. I'm actually starting to see how important it is. It's not just about legalese and corporate jargon. It's about protecting people, allowing them to take risks and lead companies without the constant fear of personal financial ruin.
And it's about protecting companies themselves, making sure they can weather those legal storms and keep innovating and growing.
It really is about managing risk and enabling both people and organizations to thrive.
Now that we've broken it down, I have a question for you. Imagine you were tasked with designing a new type of D&O coverage for today's world. What kind of risks would you prioritize? What are we not thinking about yet?
Oh, that's a good one. I'd definitely be thinking about cybersecurity and data breaches. That's a huge risk for companies these days, and the legal fallout can be enormous. Maybe there needs to be some kind of specialized coverage for those kinds of events.
Yeah, that's a great point. And what about the whole world of social media? Companies can face serious reputational damage from online attacks and controversies. Could D&O coverage evolve to address that?
That's fascinating to consider. And it makes me realize that D&O insurance is going to keep changing as the business world changes. It's not a static thing. It has to adapt to new challenges and new risks.
Absolutely. The D&O landscape is constantly evolving. New types of claims are emerging, and coverage is adapting. It's a dynamic field, and it's definitely worth keeping an eye on.
I think we've given our listeners a lot to chew on today. Thanks for joining us on this deep dive.
My pleasure. It's a great discussion.